The information below relates to Platt Heat Specialists, a manufacturer of heating equipment. All the questions relate to this business. An offer has been received for the existing machinery. The offer is higher than the market value as the machinery has been very well maintained. Since the owner, Teo Platt, had not planned to sell it yet, he asked the bookkeeper to prepare a cash budget to determine the effect of selling the existing machinery and replacing it with a newer model. However, he is concerned that the cash budget predicts an outflow of cash in July and August, in spite of winter usually being the most profitable season for this business. This exercise consists of 2 questions which are independent of each other. If you are comfortable with inventory valuation and manufacturing, you can jump straight to question 2. However, it is beneficial to do both questions, as then you get to see the big picture of a realistic scenario where all of these different topics relate to one business. You're given information relating to the inventory and the manufacturing process, and you need to use that to firstly calculate the value of stock of raw materials on hand at the end of the month. Then explain why SARS would not allow Platt Heat Specialists to use LIFO, which is last in, first out, to value their finished goods stock. Now, hopefully you might remember that although we are allowed to use the weighted average method and the first in, first out FIFO method, as well as specific identification, LIFO is not allowed by SARS. And of course, it's also not allowed under the International Financial Reporting Standards because it is unrealistic. The reason SARS doesn't like it, though, is that if we've got a state of inflation, what happens is that the closing inventory will actually be valued too low. This will result in cost of sales being too high and your profits, both gross profit and net profit, being too low, as well as tax. Obviously, the tax is the main reason SARS does not like this option. You then need to prepare the note for the manufacturing overhead costs, in other words, all of the indirect costs. You can see that they have already given you the figure for the indirect labor. And then you need to complete the statement of production costs for June. Keep in mind that your calculation of manufacturing overheads would actually feed into your production cost statement. So you can actually go and enter the heading over here that you've got your manufacturing overhead costs. You might even like to put a little 1.3 to remind you that that's where the information is coming from. While you're over here, you can enter the other missing information if you know what it is. If you can't remember what those headings are, don't stress. As you work through the information, you'll find things, and then hopefully you'll remember, oh yes, that's where it goes. The prime costs means direct costs. And so the 2 things that you might remember going here are firstly your direct materials and then your direct labor. At the end, to work from the total manufacturing costs, in other words, all the money spent in the factory, to get to the actual cost of finished goods, you adjust for your work in progress at the beginning and the end of the month. Keep in mind that the closing stock would need to be subtracted, and so you might like to put brackets in over here so that you don't forget that. Number 1.5, what is the production cost per unit. To calculate that, you would obviously need to take your production costs and divide those by the number of units that are actually produced. You can see here you're already given your production costs of 40,800, so you can use that as the beginning of your calculation. And look at that, you would already get 1 mark just from using the information that's been given above. You then need to calculate the cost of sales for June, and a hint has been given. Remember to use the correct valuation method. So we'll need to watch out and have a look to see what valuation method is used for finished goods. Because remember, finished goods are the goods that are going to be used in your cost of sales calculation. How many heaters have to be produced and sold each month to break even? Your break-even calculation involves using your total fixed costs, including all your operating expenses, divided by your selling price minus the variable cost per unit. Why is the break-even point problematic? Obviously, at this stage, we haven't read all the information, so we don't actually know. But it's useful to just keep in mind that usually, if a break-even point is problematic, chances are the break-even point might be higher than the production levels. We'd need to find out what the production levels are to determine that. And then what practical, realistic suggestion can you make to solve the problem you've identified if costs cannot be reduced? And make sure that you don't now go and use costs can be reduced as an option, because it's not. They've specifically said if you can't reduce your costs. Again, we don't yet know all of the information, but when you're looking at solving a problem to do with break-even, it's usually that you want to reduce the break-even level. And the 2 ways of doing that are either reducing costs, which has already been thrown out, that we can't use that. And the other way that we can do it is by increasing the selling price. But keep in mind that if you increase the selling price, that might also reduce the demand. Right, now that we know what is expected, we can go and use the information. The first piece of information that we're given is that Platt Heat Specialist buys kits of raw materials to be used in the manufacture of the heaters. When they are able, they buy in bulk to take advantage of any discounts offered. The raw materials are not perishable, obviously, because we're dealing with heaters. And so because of the varying prices, the weighted average method is used to value raw materials. That means that I can make a note over here for number 1.1 that I'm going to use the weighted average. And the way that you would use your weighted average is by saying, what is my value over the quantity? In other words, how much did I have on hand as a value plus what I bought as a value divided by the quantity of my opening stock plus what I bought. And then once I've worked that out, so you can actually put a little space over here if you'd like and see what do you get. But remember that after you've done that, you need to times it by the closing stock. And then you'll get your actual value. Although some stock of finished goods is kept, most heaters are produced as orders are received to aid cash flow in the current climate of inflation and constantly increasing costs. So there's just confirmation that we do have a situation of inflation, which is why we can't use LIFO. In this case, FIFO is used for the valuing of the finished goods. Remember that we've already picked up that we'll want to think about the finished goods when calculating the cost of sales. So that means that for 1.6, I'm going to use FIFO. Number 3, 35 heaters were sold during June at 2,000 Rand each. If 35 heaters were sold, that means that I'm going to need to use that as part of my calculation of the cost of sales, because those are the heaters that I'm going to need to value using FIFO. At the same time, I've also been told the selling price was 2,000, and I can use that for my break-even calculation to put at the bottom 2,000 as the selling price per unit. We're then given some figures that were extracted from the accounting records. We can see that raw materials at the beginning of the period, we had 5 kits that were worth 1,800. So that is my opening stock that I can use at the beginning of my weighted average calculation. And you can see I put the value at the top and the number of kits at the bottom. I can also use it as the beginning of my direct materials because that is my opening inventory. I can then use my work in progress at the beginning of 4,000. I can show that in the actual production cost statement. And lastly, I'm giving it my finished goods stock at the beginning of the month of 6,200. And remember, the finished goods is part of your cost of sales calculation. Now, because I'm using FIFO, it means that first I would have sold whatever I had at the beginning of the month before I do anything else. And we know that there were 35 heaters sold. So the first ones would have been the 6 heaters that were a total of 6,200, which means that I would still need to value another 29 heaters. The following invoices were received during June for raw materials. And you can see there's a number of different items and of things that we bought. But remember that we're using the weighted average method. We don't actually need to worry about the individual entries. We just need the total. So over here, we can say plus my 12,200 and at the bottom plus the 30. A stock take counted 10 kits of raw materials on hand on the 30th of June, which means I'm going to work it out and times it by 10. If you add your values and your quantities together and then divide them, you should be able to see that you get 400 Rand per unit. You then times it by the 10 kits, and that means your closing inventory of raw materials is 4,000. Keep in mind that over here, we would also need to show the purchases of 12,200 and minus the 4,000 as part of the direct material costs calculation. The costs for the month of June, we're told that raw materials was 2,480. So we can put that immediately in the raw materials. I always like to put my numbers in working brackets so that if there's adjustments, I can easily fix it. Factory wages of 12,000. Now we can see that indirect labor has already been entered as 3,000, which means that probably that 12,000 might relate to the direct labor, but I'm putting it in brackets because I'm waiting to get additional information about that. Insurance of 2,500 is an overhead cost at this stage. We don't know all the details, but you can just put it in to start with. Rent of 10,000 will also start in the overheads note. Sorry. And lastly, the depreciation on machinery of 5,500. Notice that it's because it's on machinery, it will definitely go here. Because if it was depreciation on anything else, like computer equipment, for example, that is used in the office, then that would be part of your operating expenses and would go to the statement of income or statement of profit and loss. We're then told that there are 4 factory workers. So we can see now we're being given information about the factory wages. 3 of them manufacture the heaters and 1 supervises production. The guys manufacturing the heaters are your direct labor, because you can see what they're doing in the finished product. And the supervisor is indirect, because although his job is important and is part of your total factory costs, you can't actually see what he was doing if you look at the final finished product. So that means that we can go straight to your direct labor cost of 12,000 and say, hang on, that's not all for direct. Only 3 out of the 4 relate to the direct costs of manufacturing. So you can show that direct labor is 9,000. And you can actually go and check over here. The indirect labor would be the 12,000 times 1/4. In other words, the 3,000 that has already been indicated over there. Number 9. 430 of the insurance cost is an operating expense. Remember that an operating expense will go to your statement of profit and loss or your statement of income. So what we need to do over here is take it out of the insurance to see that your insurance is then only 2,070. The rent is for the entire premises, of which 90% consists of the factory and 10% is the office, which is obviously part of the operating expenses, which goes to your statement of profit or loss. That means that over here, your rent, you will use 90%. So the total rent over here is only 9,000. We're then told that our fixed costs amounted to 32,400 for June. Fixed costs would be part of your break-even calculation. And remember, that would have been including all the operating expenses as well, because you use your total fixed costs in this calculation. The total variable costs amounted to 22,100. Now, they haven't given me the individual variable costs, but what you can do is say the 22,100 divided by however many were produced. And you can see over here, they tell you 34 heaters were produced. So you can divide that by 34 to get a total amount of 650 as your variable cost. And if you work that out, you'll see that you should have to produce 24 units to break even. At the same time, where I'm asked for the production cost per unit, I can also use my 34 over there to work out that the total cost per unit is 1,200. Now that I've used all of my information, I can go back and do all my finalizing of my calculations. 1.1 I've used, and I've already brought it down to my raw materials costs. I've answered 1.2 nicely. My manufacturing overhead costs, I would simply need to go and put all the final numbers in. Now, I didn't, in fact, need to adjust that, but that's okay. We just pop the numbers back in at the end as we need to, and then you total. And you can see that your total overheads would have been 22,050. And we've already shown that we'll need to bring it down to the production cost statement like that. We can then finish the production cost statement over here by working your direct material costs out as 10,000, which means your prime costs is 19,000. And so your total manufacturing costs are 41,050. And then what you need to do is you'll have to actually work this out as a missing figure, because you don't know exactly what the work in progress was at the end, but you can work it out by saying the 41,050 plus the 4,000 combined with the fact that the end amount is the 40,800, and you can see that you need to subtract 4,250 to be able to get that. We've worked out our total production cost per unit. We've worked out the cost of sales we can see that we use the 6,200. The last 29 heaters would need to be at the 1,200 that were produced in June. And that will give you a total amount of 34,800. And if you add those together, you can then see that your total amount is 41,000. How many heaters have to be produced and sold each month to break even? We've already worked out that that was 24 units. Now we need to think a little bit. In this case, can you see that we have actually produced more than 24 because we produced the 34 units? So the problem is not that we have got a break even that is too high and higher than our levels of production. But what we do need to keep in mind is the nature of this business. Go back and have a look at what we are doing. This business is producing heaters. Now, if you're looking at heating equipment, and we know that winter is when we are most profitable, look at the fact that we would need to actually make enough in winter to cover the summer season as well. Otherwise, we're going to struggle. So this is problematic simply because although we are selling more in winter, it's going to be difficult in summer. So now we need to think of a solution. We can use our option of increasing the selling prices. That certainly would be valid, but not very creative. But maybe we need to look at other things, like say, hang on a minute, if we can build heaters, let's maybe produce a product that is more sellable in summer. So what about adding air conditioning to the mix? Or you could look at things like reducing the price in summer to increase sales. Or you could look at things like advertising more in summer. Obviously combined with the specials that if you're going to have a special prices, etc. But think along these lines in order to come up with valid suggestions. Question 2. An offer has been received for the existing manufacturing machinery that is higher than the market value. However, the sale of the existing machinery will necessitate the purchase of new machinery. If it is decided to accept the offer, the old machinery will be sold and the new machinery bought on the 1st of July 2024. A loan will need to be taken out, the terms of which would require repayments, both capital and interest, on the 1st of every month. The business's policy is to depreciate machinery at 20% per annum on the carrying value. This is giving us a little bit of information about the things that we would need to consider if we were going to decide to actually sell the old machinery. The following cash budget was drawn up to determine the effect of accepting the offer. And you can see all the figures are given there, as well as a debtors collection schedule and additional information. What's required? We need to first calculate the carrying value of the existing machinery. Now, usually when you calculate a carrying value, it is the cost less the accumulated depreciation. Of course, there are other ways of doing it, and keep an open mind that any other information, like, for example, if they give you the selling price and the profit or the loss, you could use that to work out the carrying value. You can work it backwards from using depreciation. There's all sorts of things. So in fact, what we could also do is make a little note over here that the depreciation on the machinery is at 20% on the carrying value, because we might need that. What amount will be written off as bad debts in July? We'll have to wait until we get more information about that. Calculate the monthly depreciation on the new machinery that would have to be bought if the offer for existing machinery is accepted. Obviously, the depreciation on that would need to be 20% times the original value. And keep in mind that it's only for 1 month. So you've got to say times X over 12, and then it would be times, obviously, the cost of the new machinery. Complete the projected statement of income for the month of July. Now, a lot of the figures have been given to you, but there are also some spaces. If you are confident and can easily remember what goes into the spaces, you can put some in now. If not, you'll easily find it as you work through the information. The top 2 lines of a statement of income are generally going to be sales and cost of sales to calculate the gross profit. So we might as well put those in right now. You can see that the gross profit is given, which means that one of those is all that we need, and the other can be calculated as a missing figure. Obviously, the difference between operating profit and profit before interest expense, and between profit before interest expense and net profit, is your interest. So this first one here would be interest income of some kind. And the next one would be your interest expense. And this would obviously be on the loan. How long will it take to pay off the new loan? Now, obviously, we don't yet know all the information that's been given, but if we can find the original amount of the loan, and we can divide that by the repayments, obviously the capital portion of the repayments, that will then give us the number of months. What is the actual total monthly cost of replacing the existing machinery? In other words, by how much will monthly expenses increase? So we're going to need to work out what will the total costs be, and then compare it to the existing costs. The costs that you would need to compare would obviously be the depreciation. That is the most obvious one. But you would also need to consider the interest on the loan. And then it is possible that there might be other things that you would need to factor in as well. What you could do is you could actually create yourself little columns for the old and the new, and then you can see what the difference would actually be. Should the offer on the machinery be accepted? Explain. Obviously, this is going to depend on your answers for 2.6. This would only be the financial aspect. You could also bring in other aspects that are non-financial, but given the fact that we are doing an accounting paper, the main reasons would generally be financial. Should Teo be concerned about the forecast for the normal operating income and expenses for the next 2 months? Explain, giving reasons for your answer. Obviously, you can look at the projected statement of income to see is the actual result acceptable or not. Especially given, remember that when we looked at question 1, we saw that there's a predicted cash outflow, and that is what's concerning him. So we now want to look at, is the profit actually acceptable or not? Right, so now we can have a look at the cash budget. And what I would suggest is that you work through it step by step Use your ruler to keep your place, and each item consider if it would go into the projected statement of income or not. The first thing is your cash sales. Now, obviously, we will need sales, but it will be more than just the cash sales. But what I can do is I can put my cash sales in as a beginning figure. If you wanted to, you could even make a note that its cash is 42,000. Because remember, we are looking at July. If you want to highlight the July column so that you can understand it. They've also given August, which means we need to look at those a little bit as well, but the focus will be on July. You can see over here that the cash sales for August are going down. And the reason for that is probably because you're heading towards spring and people don't generally buy heaters at the end of winter. Your debtors collections are now given here, but remember that we were given a debtors collection schedule, so I wouldn't worry about that yet. I would wait until I get the debtors collection schedule, and I'll then use the information from there. We can see that we've got a loan figure of 250,000. Now remember that we needed to calculate how long it would take us to pay off. We can use that as the beginning of the calculation because the original loan is 250,000. We can see that the proceeds from the sale of the manufacturing machinery are 350,000. So what I would do is I would just make a little note over here that the selling price would be 350,000. Just in case I'm given a profit or loss information, then I can use that also to calculate the carrying value. You can then see that your cash purchases are given. Now, keep in mind that this is a manufacturing business, so we can't really just use cash purchases to calculate cost of sales like we normally can for a trader, because the cash purchases would generally be of raw materials, and you would need to factor a whole lot of other things into account. We have got information about payments to creditors, but again, I can't use that right now. I might need it later, but we can always come back and find it in that case. Rent is something that I will use in my statement of projected income. So obviously I can show that as part of my operating expenses. And you can see that the rent is 10,000 each month. But remember from question 1, 90% was for the factory and 10% is for the office. Remember that the statement of income that you are doing, the projected statement of income, is only for the office and the shop, not the factory. So we need to use only the 10% that relates to the office. Now we have a loan repayment of 5,000. Immediately we can use that as part of the calculation of how long will it take to be able to pay back the loan. And you can see over here that you would get an answer of 50 months. If you wanted to convert that to years, you could. Quite simply, that would come to 4 years and 2 months. You would do that by simply dividing by 12, and 48 goes into 12 4 times with the remainder of 2 months. The new manufacturing machinery purchased is 660,000. We can use that to go and calculate the depreciation. And we can see that the depreciation on the new over here would have been 660,000, obviously times the 20% times 1/12. And then you can see that the new depreciation will be 11,000. Administrative expenses are given as 8,000. Obviously, we don't need to split that up to the factory because it is admin, and you can see it's already entered in for you. And insurance, although the payment was 3,000, remember a lot of it related to the factory, so only the 430 comes in over here. Marketing expenses are given. That would be included as part of the statement of income. And we've actually got 2 figures here. What I would do is you can assume that, yes, it might be the 3,500, but maybe make a note that that was what was paid in July and 3,000 was paid in August, because we'll probably find a little bit more information. If we don't get any more information, we can use the 3,500. The other figures all stayed the same, which is why I didn't worry about them. Interest on loan has been given as 3,125. Obviously, I'm going to need to use that as my interest expense over here, 3,125 in brackets because it would be subtracted. And at the same time, I want to take it into consideration when I'm looking at whether it's more expensive to keep the old machinery or to buy sell it and get the new machinery. You can then see we've got our cash surplus or deficit combined with our bank figures, and you can see this is why the owner is a little bit concerned, because there is an outflow, as we knew. You're then given the debtors collection schedule. And again, we can't do a lot with it directly until we know when the debtors are paying us, etc. However, although we don't need the receipts, we do want to have a look at the sales. Now, if you have a look over here, you can see that the credit sales have been given. We are looking at July, which means we can use that 18,000 as the rest of my sales. So my total sales will be 60,000, which means I can work out 35,000 as my cost of sales as the missing figure. I'm then given some additional information. We can see that the depreciation on the old machinery is 5,500 Rand per month. Remember that this is on machinery, and so that was a factory expense that we already took into account in question 1. However, we can use it for comparison of looking at the depreciation. So we can see that the difference over here, the old was 5,500, the new is 11, the difference is 5,500. Of course, you could just wait and work out the difference of the totals if you wanted to. It is expected that 30 heaters will be sold in July at 2,000 each. Now, that is just giving us a little bit of extra information because I actually have already calculated my sales. But if you needed to, you could come and use this to simply say 30 heaters times 2,000 each. 30% of sales are on credit. And interestingly, here's just another way that you could go and confirm your answer. Because if we know that the credit sales of 18,000 were in July, you can say times 100, because you want the total sales, divided by the 30, which is the 18, 30% is on credit. So you can see there's actually 3 different ways that you can check yourself. You won't usually get as many clues as this, but it's quite nice to see that there are different ways that they could give you the information. Number 4, 7% of debtors usually pay in the second month after the sale and are charged interest at 12% per annum for the month. Now, we don't need to worry about the sales themselves because we've already worked out the total sales, but this is going to give us the clue for how to calculate the interest income. Quite simply, what we will go and do is go and have a look at the debtors collection schedule and see which section relates. Now, if you go and have a look at the schedule just above over here, if we're looking at July, that means that if we're going back 2 months, it means we're going June, May. May is 2 months before. So that means that it's your 20,000 that you would use times the 7% times the interest, which is given at 12% per annum, and obviously keep in mind that it's only for 1 month. And that would give you interest of 1,400, of 14. You can compare that to the interest that is shown over here, the payment that is shown, 1,414, and you can compare the 1,414 to the 1,400 of the 20,000 times 7%, and that would also give you the 14. So again, there are two different ways that you can work out that the interest is 14. %3 of credit sales are written off as bad in the 3rd month after the sale. So now we do exactly the same kind of thing. We go back 3 months and we land in April, and we can use the 19,000 times 3% to get bad debts. And in fact, I think there was a space given for us for this over here. Could actually put it over here, 19,000 times the 3%, which is going to give you 570. And then you can show that over here as bad debts. %80 of purchases are on credit from one primary supplier, Willis Supplies. Now, I don't need to worry about the purchases figure, remember, because we realized that was relating to raw materials. What we do need to worry about is the fact that they are paid within the month of sale to take advantage of the 3% discount that they offer. So what we need to do here is realize that there is going to be a discount received, which would be shown as part of my operating income. And the way that I'm going to find that is if you go and have a look at the cash payments to suppliers in July, because remember it's in the same month, and you can see over here, payments to creditors, we've got an amount of 9,700 that relates to the amount after the discount. In other words, 97, and we are looking for the discount. If you wanted to draw a little triangle to see how it works, you can see the discount would be 3%. 3% of what? It would be of the original amount of the debt. So the whole debt would be 100%, and the amount paid would be the difference of 97. And remember that the formula you use is want over got. And so you take your 9,700 that you were given times the 3% that you want divided by the 97%. That is the amount that was paid that you were given. That then helps you to calculate that the discount received would have been 300. Marketing costs are paid in the month after the costs have been incurred. And so now this explains why these figures were different. We are going to want to use the 3,000 that was paid in August, because that would have then been the expense in July. The monthly insurance premium for June was 2,500, but this will increase to account for the new machinery. That is going to be used for part of our discussion of looking at the comparison, because if the insurance premium is going to change, we need to take that into account as well. So it was 2,500. Now we go and we have a look here, and we can see that the insurance, the total insurance premium, then became 3,000. So the difference is 500. We've now used all the information that we can. Let's go and finish off the question. At the beginning, we needed to calculate what the carrying value was. And in fact, over here, you might remember that we were actually given the depreciation as 5,500. And so we're going to have to use the technique of saying the 5,500 equals whatever the original carrying value was, which we can say is X, times 20% times 1/12. Never forget that you're working with only 1 month. And so that would then give you 330,000 as the original cost. Now, what is interesting is if you have a look at your selling price and the carrying value, can you see that there's a profit of 20,000? So we can show that in the statement of income. And that's one of the reasons why it's quite a good idea to put all the relevant information that you might think of in all the places that it might be needed. Because over here, the fact that I just put the selling price in means that I can immediately see what the profit was when I've worked it out. I've already used the bad debts in the statement of income. The monthly depreciation on the new machinery, we would now need to use the cost of the new machinery. And again, if I haven't remembered to do it, I can go and fetch it by simply looking over here. There's the 660,000. And we have actually done that over there. So we can just take it up from there. It meant that it was 11,000 as the depreciation. You can then work out the rest of your statement of projected income. Obviously, your other income is 20,300. If you have a look at your operating expenses, the rent obviously should have been 1,000. You can always check yourself and see, does it actually work to 13,000? Yes, it does. Yay. Then you know you're on the right track. If it doesn't, please don't stress. If you've got time at the end, you can go and look for a mistake. But if you haven't got time, don't go and spend ages looking for it. It's probably one tiny little thing somewhere. Move on and earn marks somewhere else. What we can do, though, is we can say my gross profit plus my income minus my expenses will give me my operating profit of 32,300. Obviously, then you add the 14 to get 32,314, subtract the interest expense, and you can see you end up with a profit of 29,189. Now, remember that we were asked to find out, should he actually be so concerned about his cash outflow? And in fact, over here, the fact that he's got a profit instead of a loss is a good thing. This is obviously projected. It hasn't yet happened, but it means that he will actually be okay, whether or not he sells the machinery. So we can make a little note over here. Should he be concerned? No, because the projected profit exists. So then why is there such a difference between the profit and the cash outflow? Quite simply, the cash outflow was because of the new machinery that was bought. Even though a loan was taken out, it only covered some of the purchase price, and the rest of it was paid, would have been paid for. It was planned to be paid for. Okay. Alternatively, you could have said, yes, he should, because the sales are decreasing. that is something that you could think about. Remember, we noticed as it's going into springtime. And put the reasons here. You want to show that you are actually thinking about reality. And you can point out, if you wanted to, link it back to question 1, and then also point out that then they would only just be breaking even. Right. We've already worked out the time it takes to pay off the new loan. We can now get to the real crunch of what this question is asking us, looking at what the differences are. Obviously, the difference in the interest on the loan is 3,125. And then you can see over here, you could actually add them all up if you wanted to. The old used to have a total of 8,000 as the cost, but the new has a total of 17,125. Or you could look at the fact that it's a 9,125 as the total increase. So that means that although there's a profit of 20,000 if they sell it, the profit of 20,000 is actually not enough. Why do I say that? Because, I mean, you might look at it and go, oh, but the 20,000 is more than the 9,125. Yes, but remember, this is per month. So the profit of 20,000 is actually not enough. Costs increase by 9,125 per month. Which means that in the 3rd month, they would actually be losing out. And that's how you finish that question.